Most traders don't actually lose because they don't understand the market. They lose because they don't understand what a setup really is. And worse, they don't even know when a setup is actually valid or when they should stay out completely. So in this video, I'm going to break down what a proper trading setup is. How do you know if a setup is valid or invalid? How to enter trades correctly, and how to protect your money using stop loss and take profits. Now if you actually understand these things, you stop taking random trades and you start trading with a right structure. Now, a setup. What really is a setup? Now, all of these things that we've been looking at in our previous videos are part of what we call a trade setup. Now, a setup is simply the coming together of all your analysis and everything you use to identify opportunities in the market. It's a set of conditions that tells you a move is likely about to happen and you can take advantage of it. So when you've identified the structure, the trend, you've marked out your support and resistance and every other form of analysis that fits your trading system, and you are now waiting to execute based on your signal, that right there is a setup. Now, once a setup has been identified, what comes next? What comes next is patience. You are not just jumping into the trade, you are waiting for your signal. Now let's go on a real-time chart to see what that looks like. So like I said, a trade setup is simply the coming together of all your analysis and everything you use to identify opportunities in the market. So in this case, as you can see on this chart, we've already had our support zones marked out, our resistance that was broken and turned support, we have it marked out. So when price broke above this point here, we were simply waiting for price to come back and retest it, which price did before moving to the upside. Now that period of time when we were waiting for price to retrace, we already had a setup here, because this resistance was broken and it had turned support, so we were waiting for price to test it and move to the upside. That became a setup that we were looking out for. So now, when you've been able to identify this setup, there is actually something that a lot of traders overlook, and not every setup is worth trading. Some are valid and some are not. So after exercising patience and not just jumping into any trade, waiting for your signal patiently, you also have to make sure that the setup you are looking to take a trade from is a valid setup. Now let's go back. What is a valid setup? A valid setup is one that follows all your rules and aligns with everything you look out for in a setup, such that it makes sense based on your trading system. That is simply what a valid setup is. And then we also have an invalid setup. An invalid setup is incomplete and just doesn't line up properly with all your rules. Something is missing, hence why it can be said to be invalid. And this is where most traders make mistakes. They see something that almost looks right and they still take the trade. When you see a setup that fits your rules, 99 over 100, you shouldn't take that trade just because of that one. That's how trading works. You need everything to be in place for you to have a valid setup and for you to be able to take a trade. Now let's go on the chart. So this was a valid setup. This was a valid setup because price actually went up, broke above this point and retested around here, making it a valid setup because price obeyed the zone of interest. But you can see somewhere like this point, price actually broke through. It broke above this high, the high of this resistance. Price broke above it here, but then you can see that this was supposed to be our zone of interest after price broke it, this point where the body of the candle started. Now you can actually go back and watch my previous videos if you are not completely understanding what I'm talking about, because I've explained all these things I'm talking about in my previous videos. So having said that, this was actually a setup that we're looking at for price to retest this point here, but you can see that price came down, but it didn't respect that zone. It simply just went below it and went further down before finally taking off at this point. And you can see that this point, I'll adjust the line again to show you this point. This was also a point of support for us, and since price did not retest at this point, we could actually be expecting price to retest at this point. You remember I told you that when you are in an uptrend, which this is clearly, when you are in an uptrend, you are only looking to buy at support zones. So that is why this support became a point of interest and we're looking to buy from here. But price did react there for a bit and went to the upside, but then it came down and eventually just crashed down, went further down. So this setup became invalid because price did not respect the zones. Price did not respect this zone here by testing it and moving up, and price also did not respect this zone here by testing it and moving up. It actually just moved up a bit and it crashed down. This made this setup an invalid setup. So an invalid setup is not going to align completely with your rules of entry, and that is how you know that the setup is invalid. You should have, your trading system should have a set of rules that you follow, and when a trading setup is not following those rules, kind of word for word, then you shouldn't get on that trade. It's an invalid setup. A valid setup, on the other hand, like this one, is one that actually respects your zones. So you have price actually respecting your zone and giving you all the necessary confirmations you need to know that it is a valid setup. There are also setups that can be rendered invalid after the trade was valid. It could be rendered invalid. So you are already on a trade and everything was validated, but then price action moves in a certain way and then that setup becomes invalid. So we're going to discuss that further into the video. Like I said, this is where most traders make mistake. They see something that looks almost right and they still take the trade. Now if your setup isn't clean, just leave it, because most of the time those are the trades that end in losses. Now here's something even more important. Sometimes, like I said, a setup that was valid can become invalid, which is what I just said. The market is constantly moving and price action can shift in a way that completely cancels your idea, so your setup just fails. So in this case, for instance, this was a valid setup at some point because price came here and it had a reaction to the upside, so it was valid for some period of time. until price crashed, and at some point somewhere around here it invalidated the whole zone. So you can have a valid setup that can become invalid over time as price continues moving and price keeps on showing you different price action movements. Okay, now as a trader, you need to learn how to recognize that, like when your valid setup has been invalidated, because the market is always communicating. The problem is most people don't know how to listen. You need to know how to listen to price action, understand the language of the chart so that you are not caught unaware, because like I said, price is always moving and there are new structures formed, there are new biases, new trends, new setups, valid setups that will be invalidated, invalid setups that will become valid. Yeah, that also happens. So you need to learn to understand the language of the market. Now, knowing when to step back or when to get out will save you from a lot of unnecessary losses. Think of it like this: a setup is like a runway for a plane or a helipad for a helicopter. Everything has to be checked before takeoff. Every single thing has to be checked before takeoff, because you can't afford any mistakes in the air. Now, if everything looks good but something important is missing, it doesn't even necessarily have to be so important. It could be just one nut, a screw that's loose on one of the tires, or maybe there is no fuel. There is every other thing, but there is no fuel, or one of the wings or one of the blades of the helicopter, I don't know, has an issue or something. Just something little. It could be little, it could be big, but when that thing is missing, you don't take off. And it's the same thing in trading, you understand? So every single thing has to be on point. If there is something missing, then it's better you just stay away from that trade. With the illustration I just made, I would say it's better you just don't take off. Don't get into the air knowing that you have something missing in your arsenal of tools that are needed to make your flight smooth. So it applies same way in trading. If all your rules are not met, if all your criteria are not met by the setup, then you should probably ignore it. Now, once your setup is valid, the next question is, how do you actually get into the trade? So you have a valid setup now. What next? How do you get into a trade? Now, this is where your entry comes in. And one of the most common tools traders use is candlestick patterns. What are candlestick patterns? These are patterns formed on the chart that gives you clues about what the market might do next, the way they form, and where they form can signal potential moves. Okay, now if you learn how to identify these patterns properly, you can catch entries at key points and make the most out of a move. But here's what a lot of beginners get wrong. This is where they go wrong. Candlestick patterns form everywhere on the chart. Now, if I take you back to the chart, you are going to see candlestick patterns literally everywhere. This is a candlestick pattern. This here. This is a candlestick pattern. This is a candlestick pattern. This is a candlestick pattern. This is a bullish engulfing candlestick pattern. For those of you who watched my last video, I recommended a book, and if you've read that book, you would understand properly what I'm talking about. These are all candlestick patterns and they form everywhere on the chart. And where a lot of beginners get it wrong is that they try to trade every single candlestick pattern they see, not knowing that candlestick pattern without context, candlestick patterns formed randomly anywhere on the chart, is just noise. You shouldn't pay attention to it. So that is very wrong, because patterns outside important areas, like I said, they are just noise. They only really matter when they form at zones of interest like support and resistance. You understand? So just like, I'm going to use this example again. So just like this one, this is a bullish engulfing candle, and you can see that it formed on a point of support. So obviously it's a valid one. It's one that we should look out for. It's one that we can take a trade off of. You understand? So around this point, this was also a candlestick pattern. Yeah. So like I said, when your candlestick pattern gets formed on a point of resistance or a point of support, that is when it actually should matter to you. If not, you are just trading noise. So when a candlestick pattern forms at your zone, it can serve as a confirmation for you to enter a trade based on your system, actually, because trading systems vary. So it can serve as a confirmation for you personally based on your trading system to enter a trade. And now in some cases, you might not want to enter a trade immediately, and that's fine. You can actually wait for additional confirmation, and one way to do that is by identifying supply and demand zones. This is where strong momentum started from, after the candlestick pattern has been formed on a zone of interest. I'll take that again. This is where strong momentum started from, after the candlestick pattern has been formed on a zone of interest. Now I'll explain that with a real chart illustration. So for instance, in this case, you can see that there was all of this red candle, then this green candle again, this green candle, red, green, and then boom, we had this green candle to the upside, which actually closed above the liquidity of this last red candle that was formed on the support. At this point, this is where the liquidity is, the candle wick, this is where it started, and you can see that price clearly closed above it. So this actually gives you a strong momentum confirmation to the upside, and these are how you identify supply and demand zones after you've had your candlestick pattern formed. Let me explain with this other one. So you have your engulfing candle already. This engulfing candle is already, and every engulfing candle should actually shows momentum that you are looking for already at a supply and demand zone. So what now makes it valid or invalid is the distance of the candle wick. So for instance, this trade, the body of the candle, as you can see, is a smaller portion compared to the candle wick. So this indicates to us that there was a strong rejection, and sellers actually came in strong and really fought at this point. So this one is really not a valid supply or demand, as the case may be, because the engulfing candle did not engulf properly. Now if this candle that formed here looked something more like okay, cool, more like this, you can see that the distance between this candle wick to the body of the engulfing candle is quite large compared to the candle wick of the engulfing. I hope I'm making sense. So like from this point to this point, you can see it has a lower stretch than from this point to this point. So if this was the kind of engulfing that was formed on this point, then we'll take this point here where the body of the red candle started as our supply or demand zone. So in this case, if this was the candle that I'm talking about, if this was the candlestick pattern I'm talking about, our entry will be somewhere around here, because that is where momentum kind of started to the upside. So let me give another example, but I'm not going to use an example on a zone of interest specifically. I just want to show you an example, so when you see it on a zone of interest, you know what to do. So for instance, let's take this one. You see this one that formed here, this candlestick patterns. So you can see that you had this red candle, and then you had this green candle, and then this green candle, before you had this really bullish one that closed above the liquidity of this initial candlestick pattern. This was the initial candlestick pattern, this red and this green, you understand? So we're just waiting for price to either close to the downside and invalidate the candlestick pattern, or it will close to the upside above this candle wick, and then we'll know that okay, there is momentum attached to the candlestick pattern, and then our entry would be around here where the momentum candle started from. But this did not happen on our zone of interest, as you can see, so this one is not valid. But I just wanted to show you what it actually looks like using supply and demand after getting your candlestick pattern. So I just need you to also understand that it's very much okay to only get into your trade with your candlestick patterns. It doesn't change anything. I personally just had to change my entry pattern to this kind of entry pattern because I realized that I couldn't always be on the chart, because for instance, when you have this red candle and this green candle, and this green candle closed, that was your entry point for anyone who's trading a candlestick with candlestick pattern. If this was formed on a support, that will be your entry, so you have to be on the chart to get in on the trade, you understand? But with this one, with this other mode of entry, like also waiting for the supply and demand, I get to use a buy limit instead, so I don't have to be actively on the chart. I just set my buy limit and price will eventually go back there, almost like it just did, around here. Price will go back there and then shoot to the upside. So due to my inability to be always present on the chart, to take my entries, because I get to now do it under pressure, I'm trying to quickly calculate my lot size and all of that. So I just had to make do with supply and demand zones, because that works best, because I don't have to be on the chart. Okay, like I said, all you are doing here is looking for where strong momentum started from, and you are using that as your reference point or as your point of entry. Now, once you enter a trade, there has to be targets, whether the trade goes in profit or the trade goes against you and ends in a loss. And this is where stop loss and take profits come in. Now, what is a stop loss? This is simply the point where you exit a trade to limit your loss. That's simply what a stop loss is. So think of it as the button that kind of says, oh, I'm wrong, get me out of this trade. It's like you're telling your broker, you're giving your broker an order that by the time I lose this particular amount of money, stop me out, take me out of the trade. I don't want to lose more than that amount of money. So that's what a stop loss is. A stop loss is a point where you exit a trade to limit your loss. It's an order that you give to your broker or your prop firm, and it's like you're telling them exit at this point. I do not want to lose more than this amount. So that's what a stop loss is. Now a take profit is where you close your trade to secure your profited gains. So when you've made some gains, your take profit is simply the button that tells your broker, I've made enough, now lock in my profits, close the trade, keep my profits, I'm good with this. You understand? So it's like the opposite of a stop loss, obviously. And these two are very, very important because they protect you from greed and emotional decisions. You understand? So they also like allow you to step away from the chart without needing to monitor every movement. So instead of seeing a trade and you're like, oh, let me let this trade run a little more, or let me adjust my stop loss because I think the trade is still going to go in my favor, so I want to adjust my stop loss and make my risk bigger, or just basically listening to your emotions rather than being a professional trader that is following a proven edge and system. So your take profit and your stop loss would help you to a very large extent shed off your emotional side and just stick to what it is. You understand? So now how you set these levels actually depends on your system. But one important principle is this: you define your risk first. Now what do I mean? For example, if the point from your entry to your stop loss is 20 pips, your take profit can be 40 pips. Now that's a 2-to-1 risk to reward, meaning if you risk $100, you make $200. Now some traders use only zones of interest to mark out their targets for profits and stop loss too, as the case may be. And some others use a fixed risk to reward, but a smarter approach which a lot of professional traders use is combining both of them. So you take profit at key zones while still respecting your risk to reward ratio. I hope that makes sense. Now this is where partial profit comes in. What are partial profits? This is when you close part of your trade at certain levels to secure gains or reduce risk exposure. So it's not talked about enough actually, but it plays a huge role in growing your account over time. For the longest time, I really didn't know about this in my trading journey, up until sometime like 2, 3, 4 years down the line was when I got to know about partial profits, because like I said, it's not talked about enough, but it is one of the very major pillars that will help you sustain your account and keep you from blowing it. Because when you take partial profit, some people, I think it's a thing of ego. A lot of traders just have this ego that they want to satisfy. They have this pride, like, oh yeah, I took a 3-to-1 risk to reward, I took a 4-to-1 risk to reward, and I hit my target. I made $400 risking $100. So they want to satisfy that ego. So they don't talk about partial profits that much. But actually, taking partial profit is one of the best ways, like I said, to preserve your account. This is one of the major things that professional traders do. that you don't see most of them talking about too much. I don't know if they expect everyone to know, but yeah, it's something I had to learn the hard way. And I'm really happy I'm able to share this experience with you guys and to make sure that you avoid that same mistake. Closing partial profits might seem like um, a cowardly thing to do, because it's like you are not waiting for price to hit your target. But a very respected trader in the industry once said, the goal of trading is to make money and not to be right. Like, if I take my trade and I risk $100 and I make $200, I've made some money, compared to the trader who risked $100 to make $400, but price reversed at $200 and went back to his stop loss. So that trader hasn't made money, but I was able to make money because I closed partial profits. You understand? So it's something that actually helps your account grow over time, but it's like a very, very silent fertilizer. It's not loud, it's not something that is very much talked about, but it actually helps a lot. And it goes the same way for your stop loss, for your loss. There should be, when price action tells you a story after you've entered a trade, price action could actually tell you a different story, and you have to adjust your stop loss to reduce your risk. So it goes both ways. There's partial profit, and partial profit is more of the thing you should do, while for stop loss you just have to adjust. These are the things I'll be talking about actually in my next video. Trade management is very, very key, and it's something that every trader needs to understand to make sure that their account is preserved in the long term. So for instance, let me just give an illustration about this. So let's say for instance we took a trade. Okay, let's say you took a trade here. This was your point of entry and this was your stop loss. You understand? So like, let's say your full target was a 2-to-1 risk to reward, but before price got to your target, it actually reversed. So considering that, so this second mark out you are seeing is the 2-to-1 risk to reward. This is the 2-to-1 and this is a 1-to-1. So you can see that, let's say you entered at this point. I'm just giving an instance, like this is not necessarily how I enter the market. We'll get on that over time. Let's say this was a point of entry and you got in at this point. So this is a 1-to-1 risk to reward. So for someone okay, let's say there's trader A and trader B. Now trader A got in on the trade, and when price reached a 1-to-1 risk to reward, trader A closed 50% of his profits. So now he's left with only 50% running, and trader B is waiting for the final target because he has to be right? So you can see that trader A took profits, price eventually went down and hit the stop loss, and trader A made 50% and lost the remaining 50%. So what does that tell you? 50 minus 50, 0. So trader A did not lose any money. But then there's trader B who was waiting for the final target, which price did not eventually reach, and price just dropped back and came all the way down to the stop loss. So now trader B has lost a whole $100, while trader B is still $100 up. because he was able to take partial. So do you understand the concept now? So it actually looks like it's a small thing, like it doesn't really matter. But over time, you would notice that trader A would be much more profitable than trader B, especially when the market conditions are not so good. You understand? That's when you need to be really conservative. And as at that time, trader A is going to stand the test of time as opposed to trader B, who is letting his ego decide, his trading actions. So you need to have that in mind. So, like I said, it's not talked about enough, but it plays a very huge role in growing your account over time. Now, where you take profits or cut losses is not fixed. It depends on your system and your understanding of price action. It's something that you develop over time as you grow as a trader. You understand? As you get to understand your trading system more, as you get to understand price action more and gain more experience, then you begin to know exactly where to take profit and where to cut your losses, because it is not fixed. Price almost never repeats a pattern exactly the same way. So you need to be able to identify, structures, formation of new structures, new setups, new zones, and all of that, so you can properly, manage your trades to be consistently profitable over time. So that's it for that. Now, if you found this helpful, then you are starting to understand trading the right way, not just entries, but structure, discipline, and risk management. Now, make sure to like the video, subscribe, and turn on notifications, because in the next video I'll break down trade management, and trust me, you do not want to miss that. So let's have a brief preamble of what we discussed. We talked about a setup, what a setup is, and how a setup is the coming together of all your analysis and everything used to identify opportunities in the market. And we said there are two different types of setup, so to say. We have a valid setup and we have an invalid setup. A valid setup follows all your rules and aligns with everything you look out for in a setup, such that it makes sense based on your trading system. But an invalid setup is the opposite, and it doesn't line up properly with all your rules. Something is missing, hence why it is said to be invalid. And then we said, after we've identified a setup, knowing if it's valid or not, we get in using candlestick patterns, which are patterns that are formed on the chart that gives you the clues about what the market might do next. The way they form and where they form can signal potential moves. And we said, after candlestick patterns, you also can wait for further confirmation, which is very much optional. It is not compulsory. Having candlestick pattern confirmation is already enough to get into a trade. But for those who might want to use limit orders like me, you could also use the supply and demand concept. This is where strong momentum started from after the candlestick pattern has been formed on a zone of interest. So we also talked about how, after getting in with a candlestick pattern and supply and demand, as the case may be, you have to have a stop loss, which is the point where you exit a trade to limit your loss and make sure you are not losing too much. We also have a take profit, which is where you close your trade to secure your profited gains. So they are basically the opposite of each other. And then we also spoke about how you can close partial profits rather than letting your ego decide and waiting for price to hit your final target. So this is when you close parts of your trade at certain levels to secure gains or reduce risk exposure. So that is it for today's video. I really hope you guys enjoyed this. So don't forget to like, share, and subscribe, because we're going to keep this coming, and hopefully we all get to understand how trading works properly without the noise. So I'll see you guys in the next video, where I'll talk about trade management and everything that has to do with trade management, SL and TP adjustments, new structures, exits before targets, taking partial profits. All of these things we have spoken about already, most of them, but in a more elaborate form. So stay subscribed, and I'll see you in the next video.